Bitcoin is down about 50% from its all-time high. We're trading in the low 60,000s, and sentiment looks very different than it did at the top. This is usually the point in the cycle where people stop thinking about upside and start thinking about risk. Not theoretical risk, but practical risk. Volatility has always been a part of Bitcoin. And what tends to surprise people is how much of the risk actually comes from the way they choose to purchase Bitcoin. So today, instead of talking through price targets or cycles, I'm going to walk through 3 different ways that people can access liquidity while holding Bitcoin and compare them across the same set of considerations: Bitcoin-backed loans, home equity lines of credit, and Horizon. So here's a comparison table that I made to compare all 3 of these options and the risks that they carry. So the first thing that matters is what asset is actually carrying the risk. With Bitcoin-backed loans, your Bitcoin itself is collateral. Its price movements directly affect the stability of the loan. If Bitcoin's price falls rapidly, your loan can be margin called, and if you're not careful, your Bitcoin can get liquidated. Unfortunately, now that Bitcoin is falling quickly, people are having to make the decision to either post more Bitcoin as collateral, pay down their loan, or lose their entire stack. With a home equity line of credit, the collateral is your home. Your Bitcoin sits outside the structure, so it's not prone to liquidation risk, but that monthly obligation still exists regardless of what markets do. So you can safely navigate around price-related liquidation risk, but it still comes with a monthly payment, which we'll talk about in a moment. And with Horizon, the collateral is a portion of your home's future value. So the structure is tied to the value of your home over time rather than to daily price movements in Bitcoin. Your Bitcoin is not held as collateral. In fact, you're free to custody it however you choose, similar to if you were to purchase Bitcoin through a HELOC. This difference sets the tone for everything else that we'll touch on. So the next thing we're going to talk about is monthly payments. The obvious next question is whether the structure demands ongoing cash flow. Bitcoin-backed loans typically require interest payments and often principal as well. Even when loans are interest only, those payments don't pause during market stress. HELOCs are much more familiar. Many of you watching this video probably have dabbled in them. They come with monthly payments that combine interest and principal, often at variable rates. Horizon does not require any monthly payments. There's no interest schedule and no cash flow obligation tied to market conditions. And that distinction becomes especially important during times like these, when Bitcoin's price is falling and when liquidity matters a lot more than leverage. The next thing we'll talk about is interest rate sensitivity. So this is another layer of risk that often gets overlooked. Bitcoin-backed loans usually carry variable rates that can change as liquidity tightens. HELOC rates are also directly influenced by the Fed's policy, their variable rates, which means payments can rise even if nothing else in your life changes. Horizon, on the other hand, does not have an interest rate. The structure does not compound over time and doesn't adjust based on monetary policy, so that removes an entire category of uncertainty. This is the section that matters most in a bear market. We're going to ask, what happens if Bitcoin drops 50%? Well, when Bitcoin drops sharply, as I mentioned, Bitcoin-backed loans move closer to their loan-to-value ratio. That can trigger margin calls, requests for additional collateral, or forced liquidation altogether. With HELOC, Bitcoin price movements don't directly affect the loan, but the monthly obligation, again, remains unchanged. So the stress shows up through cash flow instead of liquidation potential. With Horizon, a drop in Bitcoin's price doesn't trigger any action. There are no margin calls and no forced decisions. The structure is designed so volatility can exist without forcing a sale. This naturally leads to the question of forced selling. Bitcoin-backed loans, of course, carry a high risk of forced selling during drawdowns, and liquidations tend to happen during these periods of extreme volatility. HELOCs reduce that risk, but they do not necessarily eliminate it. If payments become uncomfortable, selling Bitcoin can still become the easiest way to restore cash flow. Horizon also removes that pressure. There's no mechanism that requires Bitcoin to be sold in response to price movements over time. Ownership and optionality over what you choose to do with your Bitcoin remain intact. Now, control matters, especially when systems are stressed. Bitcoin-backed loans usually require Bitcoin to be held with a custodian or a lender. Some platforms do allow you to have peer-to-peer Bitcoin-backed loans, which eliminate custodial risk, but often this comes with a higher APR and potentially higher margin requirements. HELOCs and Horizon allow you to retain full control of any Bitcoin you acquire. There's no rehypothecation and no counterparty exposure tied to your holdings, whether you choose to hold it with a trusted custodian or bypass custodial risk entirely and hold it in self-custody. Your Bitcoin is entirely your own. And that separation becomes meaningful if you really value true ownership over your funds. It's also worth asking what kind of mindset each structure is built for. Bitcoin-backed loans and HELOCs tend to assume stable conditions and manageable volatility, so they work best when Bitcoin's price cooperates. But Horizon is uniquely built to withstand price drawdowns, allowing homeowners to rest assured that their Bitcoin is safe and secure, regardless of intraday price movements. Our goal is to enable financial independence through long-term Bitcoin exposure by unlocking trapped capital from your home without the headache of monthly payments or the stress that comes with liquidation risk. Bitcoin's volatility is not going away, and each bull and bear market has proven that. The real question is whether your financing model can coexist with that volatility, or whether it turns normal drawdowns into forced selling events. Volatility is a part of Bitcoin, but liquidation risk doesn't have to be. And Horizon was built to let people hold through bear markets without managing margin potential or monthly expenses. If you want to explore how it works or see whether it fits in your situation, you can learn more at joinhorizon.com. Thank you very much for watching this video. If you'd like to stay notified whenever we post these, feel free to follow us and turn on notifications. And if you'd like to schedule a one-on-one call to have more questions answered, you can book one at the link in the video description or the pinned comment. Take care, everyone. We'll see you next time.